Hi, and welcome to the channel. For those of you new, my name is Dave and I work in financial services. And these videos are a mixture and journey towards financial freedom that will cover financial well-being and financial products so you, like me, can reach your goals sometime in the future. Now let's get into this latest video. Now this latest video is about my self-invested personal pension plan for the month of May 2023. Now I do have a workplace pension with a current provider, but I'm restricted on one, the contributions I can pay in, and two, the funds I can invest in. So I've got my own personal SIPP so I can control level of contributions and which investments I can pick. Now for those of you new, the plan is a year-end return of 10% each year. For this year we're looking for annual dividends of £4,500 and a year-end valuation of £117,000. So how have we done during the month? Well, we started the month at £104,661. End of the month, not so good, £101,901. A loss in the month of £2,750. Year to date, our return at the end of May was 4.57%. And what sort of contribution have we made during the month? Well, we made normal contribution of £200 a month, with the government added tax relief of £50, and as we can see from the chart, predominantly based in financial services, so the big banks, the insurance companies within the UK. And our platform provider has charged us monthly fees of £14.30, which is about the same as previous months, based upon a percentage of where our portfolio is held. So, whereabout geographically is the portfolio held? Well, predominantly based in UK and Europe. 83.56% is in UK and Europe. 14.29% is in USA and Americas. And a tiny percentage of 2.16% is in Asia and emerging markets. Now, we did have a very good month of dividends, our best month of the year to date. Our portfolio has got 15 shares. It's given an annual yield or an average yield of 4.06%. And if you look at the following graphic, we received during the month £1,705.54. So year to date, £2,185.69. So which companies gave us dividends? Well, for our Fidelity World Index Fund, it gave us a tiny dividend of £4.46, but it's one we've only invested recently. We're putting contributions in, but that dividend will substantially increase as we're allocating more money into the portfolio on a month-by-month basis. We received a very nice dividend from Aviva, the insurance company, £894.24. Reinvested, we got 213 new shares. From Drax, the biomass or the pallet maker, £151.95 gave us 23 new shares. Lloyds, the banking group, gave us £532.57, gave us 1,141 new shares. And finally, Greggs, the bakers, gave us £122.32, gave us 4 new shares. So all the money was reinvested into the portfolio. Let's dive into what sort of holdings we have in our portfolio. Now, these are my own personal opinions, okay? I picked them all shares and we're happy to pick, shall we say, the next 3 to 5 years. I've got no reason to sell any shares unless something drastic happened to the company. They were bought for a specific reason. Now, we did say we own 15 shares, 9 in profit, 6 in loss. Total share value collectively is £79,767. Makes up 78% of our portfolio, of which 67% is in the FTSE 100 and 11% is in the FTSE 250. Now, predominantly, shall we say, based in financial services, our 2 largest holdings are Aviva, 4,533 shares, nearly £18,000, 18% of our portfolio. Lloyds, the banking group, 34,427 shares, £50,500, makes up 15% of our portfolio. So our 2 largest holdings. We're not putting any more money into them holdings, but we are reinvesting shares to give us, shall we say, better dividend returns. We own 282 shares in Greggs. We were given 4 in the month, £7,500, 7.4% of our portfolio. Very good results, very good trading dividends statements in the month. And our next holding is Drax. Has struggled during the end of the month, but again, some very good results, very good dividends. And we've now got 1,229 shares, £6,800, 6.5% of our portfolio. Now, one holding we have increased recently is HSBC. 1,108 shares, £6,500, 6.5% of our portfolio. Has been on a very good run recently, very good results, away from the UK banks. Quarterly dividends are being reinstated, and it is paying a special dividend at the start of next year. Back onto the banks, we own Barclays, 3,038 shares, £4,600, 4.5% of our portfolio. And then one share we've been increasing lately is Legal & General. 1,937 shares, £4,500, makes up 4.5% of our portfolio. But again, it will pay a very nice dividend. Start of June, the yield is around about 7%, but fully covered. Our next holding is somewhat of a growth company, JD Sports. 2,500 shares, £3,800, 3.7% of our portfolio. Very cash rich, does pay a very small dividend, has got some great results recently, made over £1 billion profit, and it is on a buying spree. Has been in the US past months. It's now going to venture out and buy certain companies within France to increase its presence across Europe, but a very cash rich company. We own 1,194 shares in Sainsbury's, the retailer, £3,200, 3% of our portfolio. Has struggled lately, but everyone needs to eat, everyone needs food, but it isn't some kind of pricing war against the UK retailers. And then other shares we own is Shell, £3,500, 3% of our portfolio. BP, £2,500, 2% of our portfolio, but they were bought because they're very cash rich. They are paying very nice quarterly dividends, which will be reinvested within the portfolio. And other fund shares we own is Pennon, the water company. We own AG Bar, the drinks provider, will pay a small dividend at the start of June. We own AJ Bell, the platform provider, and we own some shares within Card Factory. So a collection, shall we say, 15 shares, predominantly based in financial services, but they were all bought for a reason. And as we've said, a very nice month during the month. £1,700 in dividends, which was all reinvested back in the portfolio. Now remember, these are my own opinions. If you like the videos, smash the like button, subscribe to this channel. Now let's look at what sort of funds we have within our portfolio. So at the moment we own 7 funds. 3 in profit, 4 in loss. £22,000 makes up 21% of our portfolio. And we have been increasing one of our existing funds, a Fidelity World Index, through monthly contributions. So we put in £240 during the month of May. So a quick summary of where our holdings are. We own a Legal & General Technology Fund, nearly £8,000, 8% of our portfolio. Owned around about 260 stocks within the tech sector. It was done for diversification. Has struggled in 2022. Has had a great run in 2023. We own a US smaller companies, £3,500, 3% of our portfolio. Has struggled during the past few months. It may well be moving forwards when it's back into profit. It's showing a small loss at the moment, but when it's back in profit, we may put that into our Fidelity World Index away from the US sector. We own a Bally Gifford Positive Change, £3,500, 3.4% of our portfolio. Owns around about 35 shares in selective companies for ESG and social governance, but has had a very good track record and it is in profit. We own a Lindsell Train UK Equity Fund, £2,800, nearly 3% of our portfolio. It's got, shall we say, about 40 stocks in, big known players within UK, all well-established names, does what it says on the tin, but it's bought because of an excellent track record over the last 10 to 15 years. We can just switch off. It's given us diversification across top funds within the FTSE 100. One fund that has struggled recently is a global growth fund. £2,300, 2% of our portfolio, but again it was done for diversification, but unfortunately it struggled over the past few months. And the fund we've been topping up is a Fidelity World Index. We're putting in, let's just say, between 200 and 250 a month, and we've now got in that fund £1,336, makes up 1% of our portfolio. Owned around about 1,500 shares, very low cost of 0.11%. We can just switch off. It was done for the diversification. And then our smallest fund has struggled. We put £1,000 into a UK smaller companies. Ideally, smaller companies will normally do better than larger companies. For some reason, it struggled during the past 12 months. It's now down to £709, but thankfully it makes up 0.7% of our portfolio. So it has struggled. It's down about 30% since we bought it, but we're just going to switch off. It will recover. And remember, these are my own personal opinions. We've got 7 funds. Okay, it may well be we simplify them funds moving forwards and have, shall we say, tracker funds, okay, or global funds. But we see no reason apart from one fund, a US smaller companies fund, why we're going to, shall we say, exit that fund unless market sentiments change or the management change within that fund. So, although we've had a poor month during May, year to date we're still showing a profit of over 4%. We are well above our targets and where our dividends are. And as we said, it's not a get-rich-quick scheme. Slow and steady, it will meet our objectives over the next months, over the next few years. Remember, if you like the videos, smash the channel, smash the like button, and we'll see you again soon.